The artificial intelligence revolution is not a software miracle. It is the most aggressive, debt-fueled physical infrastructure built out in modern economic history, and it is currently masking a systemic financial contagion. The global narrative insists that we are entering a utopian era of infinite, frictionless digital intelligence. The macroeconomic reality, however, dictates that we are meticulously reconstructing the exact financial architecture that triggered the devastating telecommunications crash of the year 2000. The current financial bubble is not located within the sophisticated algorithms, the large language models, or the generative chatbots. The bubble is physically located in the concrete data centers, the miles of copper wiring, the massive cooling towers, and the tens of millions of highly specialized silicon processors being stockpiled around the globe. To comprehend the magnitude of this impending financial catastrophe, one must stop looking at the software interfaces and start examining the brutal, unforgiving mathematics of capital expenditure. The hyperscalers, the massive technology conglomerates including Microsoft, Alphabet, Meta, and Amazon are currently engaged in an unprecedented arms race of hardware acquisition. In the year 2024 alone, the combined capital expenditure of these technological titans targeted specifically at artificial intelligence infrastructure eclipsed $200 billion. This is a staggering front-loading of capital that dwarfs the entirety of the Apollo space program, adjusted for inflation. They are purchasing specialized graphics processing units, specifically the incredibly expensive NVIDIA H100 and B200 clusters, by the hundreds of thousands. They are constructing massive, hyperdense server farms that span millions of square feet. This is not a gradual, demand-driven expansion. It is a speculative, panic-driven land grab, fueled by the terrifying assumption that the entity with the most raw computational power will automatically secure a permanent monopoly over the future of human commerce. However, this massive deployment of physical capital relies on a fundamental economic equation that is currently broken beyond repair. The core of this impending collapse is a mathematical impossibility known within institutional financial circles as the depreciation-to-revenue gap. The entire artificial intelligence industry is built upon a foundation of rapidly decaying assets. A commercial skyscraper can generate rental yield for 50 years. A traditional manufacturing facility can operate profitably for decades. But a state-of-the-art artificial intelligence hardware cluster possesses an aggressively short, mathematically terrifying life cycle. Compute hardware depreciates violently. An NVIDIA H100 processor, purchased today for $30,000 or $40,000, will be rendered technologically obsolete and financially uncompetitive in approximately 36 to 48 months when the next generation of vastly superior, more energy-efficient silicon is introduced to the market. Therefore, the astronomical upfront cost of that hardware must be entirely recouped, and a profit margin must be generated by the software revenue running on that specific hardware within an impossibly tight 3 to 4 year window. When you extrapolate this depreciation cycle across the entire macroeconomic landscape, the numbers become absolutely catastrophic. Leading financial institutions and venture capital analytical firms have modeled the required revenue generation to sustain this hardware boom. The mathematics are staggering. If the global technology industry spends $100 billion on graphics processing units in a single fiscal year, that raw hardware cost is only the beginning. When you factor in the massive energy cost to power those chips, the millions of gallons of water required to cool them, the physical real estate of the data centers, and the 50% gross margins demanded by the cloud service providers who host them, the end-user artificial intelligence software market must generate roughly $300 billion to $400 billion in high-margin, recurring revenue just to break even. This is an annual requirement, an inescapable debt obligation tied to the lifespan of the silicon. Now, compare the required $300 billion to the actual verifiable software revenue being generated by the market today. Outside of a handful of heavily subsidized, dominant foundation model developers, the consumer and enterprise software market is generating a microscopic fraction of that required capital. The vast majority of consumer applications are operating at a massive loss, offering heavily subsidized access to complex models to artificially inflate their user acquisition metrics. In the enterprise sector, corporations are running limited pilot programs and beta tests, entirely unwilling to commit hundreds of millions of dollars to unproven software solutions that frequently hallucinate data and introduce severe cybersecurity vulnerabilities. There is currently an estimated $600 billion gap between the capital being burned on physical infrastructure and the actual revenue being collected from end users. This is not a temporary market inefficiency. It is a structural void. The math simply does not bridge the gap, and the debt clocks are already ticking down on the hardware depreciation cycle. The question that immediately arises is how thousands of wildly unprofitable, highly speculative startups are managing to secure tens of millions of dollars to purchase or lease these incredibly expensive compute clusters. The answer exposes the darkest, most vulnerable layer of this financial bubble: the rapid proliferation of artificial intelligence shadow banking. During previous technological booms, venture capital firms would provide direct equity funding to startups to build their products. However, modern venture capitalists have become acutely aware of the hardware depreciation trap. They are increasingly refusing to write massive checks that will simply be handed directly to hardware manufacturers and cloud providers. They demand that startups operate lean, focusing purely on software development. But the startups cannot build the software without the massive compute power. This friction has birthed a terrifying new ecosystem of specialized unregulated lenders, private credit firms, and neo-cloud providers who are willing to finance the hardware. These shadow banks are executing multi-million-dollar loans to startups with zero revenue and zero proven business models. To justify the risk, they are utilizing the graphics processing units themselves as the underlying collateral for the debt. The financial mechanism is fundamentally identical to a commercial real estate loan, where the physical building secures the mortgage. But this represents a fatal misunderstanding of the underlying asset. A commercial office building, while currently distressed, is a physical structure bolted to the earth that retains intrinsic geographic value. A compute cluster is a highly deflationary piece of technology. The lenders are treating depreciating silicon as if it were appreciating real estate. When a startup inevitably fails to find a profitable market fit and defaults on its loan, the private credit firm plans to seize the compute cluster and liquidate it to recover their capital. But they are operating under the delusion that the hardware will retain its value. When the next generation of vastly superior microchips hits the market, the value of the previous generation implodes overnight. A cluster that was purchased for $50 million may only command $10 million on the secondary market 3 years later. When the market value of the hardware suddenly drops below the outstanding value of the loan, the collateral completely evaporates. This will trigger a devastating wave of margin calls across the private credit sector, wiping out the unregulated lenders who believed they were holding secure, asset-backed debt. Yet, even if the financial engineering could somehow be sustained, the artificial intelligence bubble is rapidly approaching an inescapable physical barrier: the global energy wall. The expansion of digital intelligence is not happening in the cloud. It is happening on the physical earth, and it requires an absolutely staggering, geographically transformative amount of raw electrical power. The fundamental act of running a sophisticated language model is incredibly energy-intensive. For context, a standard algorithmic internet search requires roughly 0.3 watt-hours of electricity. It is highly optimized and remarkably efficient. A single query processed by a modern generative artificial intelligence model requires nearly 3 watt-hours of electricity, representing a massive 10-fold increase in power consumption for a single user interaction. When multiplied by billions of daily interactions across the globe, the power requirements cease to be a technological issue and become a matter of national security and grid survival. A modern, hyperdense artificial intelligence data center does not plug into a standard municipal power grid. These facilities require hundreds of megawatts, and increasingly, full gigawatts of dedicated electrical capacity. They require so much raw power that the technology giants are literally breaking the public utility model. They are bypassing the standard electrical grid entirely, realizing that municipal power generation cannot scale fast enough to meet their desperate need for compute. This has triggered massive, unprecedented capital moves, such as major technology conglomerates directly co-funding the construction of small modular nuclear reactors or signing exclusive, multi-decade purchase agreements to restart dormant nuclear facilities like 3 Mile Island. They are attempting to privatize nuclear power to feed the data centers. But this energy desperation exposes the physical limit of the bubble. You can print infinite money to fund startups, and you can write infinite code to build new models, but you cannot instantly materialize gigawatts of electrical transmission infrastructure. The grid interconnection queues in prime data center markets like Northern Virginia and the Pacific Northwest are backed up for 5 to 7 years. Energy providers are actively denying new grid connections to data center developers because the local infrastructure would literally melt under the load. What happens to the financial model when a massive neo-cloud provider secures $2 billion in high-interest private credit, purchases 100,000 graphics processing units, builds the physical shell of the data center, and is then informed by the utility commission that they cannot receive power until the year 2030? The hardware sits in the dark. It begins depreciating the moment it leaves the factory, losing millions of dollars of value every single month, while generating absolutely zero revenue to service the debt. The energy wall guarantees that massive portions of this physical infrastructure will become stranded, useless assets long before they ever process a single line of code. As the physical infrastructure buckles under the energy strain, the software layer is simultaneously being destroyed by aggressive, relentless commoditization. The entire financial justification for the trillion-dollar hardware spend is the assumption that artificial intelligence will remain a highly proprietary, incredibly expensive, and deeply guarded premium service. Investors are funding startups based on the belief that these models will establish an impenetrable technological moat. However, the exact opposite is occurring. The massive capital expenditure is heavily concentrated in the training phase, the incredibly difficult and expensive process of teaching the model. But the long-term economic reality of the industry resides entirely in the inference phase, the everyday execution of the trained model by the end user. The industry is currently witnessing a brutal compression of value driven by the rapid advancement of open-source models. Organizations with immense capital are spending billions to train highly capable models only to release them to the global public for free. These open-source models are rapidly approaching the complex reasoning and output capabilities of the most expensive, proprietary models on the market. Intelligence is not remaining a premium software product. It is violently and rapidly becoming a commoditized open-source utility, much like basic internet access or cloud storage. When high-tier artificial intelligence capabilities become virtually free to the end developer, the entire ecosystem of thousands of enterprise software companies charging steep monthly subscription fees for what is essentially an interface wrapper around a language model will instantly collapse. Their revenue will go to zero overnight, completely undercut by free alternatives. But while their revenue vanishes, the multi-million-dollar compute contracts they signed, the massive hardware leases they committed to, and the venture debt they accumulated will remain on the books. They will possess the intelligence, but they will lack the margin required to survive. This impending collision of hyper-depreciation, shadow debt, energy limits, and aggressive open-source commoditization guarantees a spectacular financial reckoning. To understand the aftermath, one must look directly at the echoes of the dot-com crash. In the late 1990s, telecommunications companies engaged in a frantic, debt-fueled race to lay millions of miles of fiber optic cables across the ocean floors and beneath every major city, driven by wildly inflated projections of future internet traffic. When the reality of consumer adoption failed to match the astronomical capital expenditure, the telecommunications sector imploded. Dozens of massive corporations filed for bankruptcy simultaneously, but the physical cables did not disappear. They remained buried in the dirt, completely unused. They became known as dark fiber. The financial architecture burned to the ground, but the physical infrastructure survived, eventually purchased for pennies on the dollar by the surviving conglomerates, which then laid the foundation for the actual internet revolution a decade later. We are currently building toward a terrifying era of dark compute. The artificial intelligence revolution itself is fundamentally real, and the technology will inevitably reshape human industry. But the specific financial structure currently supporting it is a debt-fueled hallucination. The mathematics dictate an absolute certainty. The revenue will not arrive in time to pay off the hardware. When the margin calls begin, the startups will default en masse. The unregulated private credit firms will seize the aging compute clusters, only to discover they are holding completely obsolete, worthless silicon. The specialized neo-cloud providers will collapse under the weight of their own debt and energy bottlenecks. The data centers will go dark. The massive technology monopolies, the entities that ignited the arms race in the first place, will simply stand in the wreckage and purchase the distressed physical assets, the stranded power contracts, and the bankrupt data centers for fractions of a penny on the dollar. The technological progress will continue unhindered, but the victims left bleeding in the streets will be the private credit markets, the retail investors, the venture capitalists, and the thousands of ambitious startups who fatally leveraged their entire future on the deeply flawed assumption that raw compute power was a safe financial asset.